Good morning, good morning, good morning. How's everybody doing? Cash flow and profit, very important, right? We're not buying real estate to lose money. We want to know how much profit we're going to make. It's not worth the $20,000, right? But if we can buy it and then sell it the next day and make $20,000, that $20,000 is not that bad.
There's so many intricacies of a deal, so many different ways to work it and add value. The more you know, the more you can capture value on one angle. Hey, Mr. and Miss Seller, we'll pay you double the value of the property, but you work with us up front and you can make a trade-off there.
And this is where the creativity, being able to think strategically, go into these negotiations, into these conversations, and use the entrepreneur method. Everything we talked about yesterday and everything we're going to do live today is really important. Cash flow and profit, very important, right? We're not buying real estate to lose money. We want to know how much profit we're going to make. This is kind of where it comes into play with how I'm saying there's not a cookie cutter way to analyze a deal. There's a lot of things that come into play, and then there's a lot of, business and personal things that might be going on that also come into play, right? Like how much time is going to be needed of me and Matt to oversee a rehab to get $20,000 worth of profit on a flip. If we're only getting $20,000 worth of profit on a flip, but we have to put $400,000 up as a down payment, and we also have to spend an entire year overseeing a rehab and contractors in the city, it's not worth the $20,000, right? But if we can, buy it and then sell it the next day and make $20,000, that $20,000 is not that bad. Does that make sense?
Yeah. That's to the point. I mean, there are these basic rules, but then there's so many intricacies of a deal, so many different ways to work it and add value that the more you know, the more you can capture value on one angle or another.
But cash flow and profit is important. I also know that on a flip, $20,000 that might be my profit is not that much profit, and that could go negative very fast.
We were talking about that yesterday, right? He was saying he was looking at something that he was going to be in for $250 and you're going to sell it for $300. Right? He's all in for $250, gonna sell it for $300, and it's like, man, don't do it. Why? Because just think about it. Commissions that you're gonna pay, holding costs. Even if you were truly gonna make $50,000, you're gonna pay short-term capital gains taxes on $50,000 of 30%, and that's if nothing goes wrong. But reality, you really need 170, and that would be after commissions, factor in all the loan costs, everything to feel comfortable, because something goes wrong, 20, 30K expense, you can lose money pretty quickly.
Not only that, you got the 20, 30K expense that you weren't expecting, but then you get it listed, and now the market's different. It's sitting on the market 2, 3, 4 months, and you have to drop the price 30, 40 grand to get it sold, and now you're deep in the hole, right? So you want to make sure that your profit that you're calculating is enough to ensure that you have enough room there for those variables that may end up, costing you more money. And number two, that the profit is worth your time, right? It may not be worth it for you to go through an entire flip or an entire, whatever the project is, to make $15,000 at the end of the 8 months for a full-time job, right? You'd make more probably working at your other full-time job than doing that. So you have to weigh these factors into your deal analysis. We've never really done a full-on entire remodel on a flip. There's a lot of things that can go wrong. It's a full-time job. My favorite flips are the flips that we can get in and get out very fast. We've done a few flips with Doreen, and we're done with the rehab in 7 to 10 days. And we really like that for a few reasons, right? Number one, it doesn't require that much work from us. Number two, it reduces a lot of the risk because we're only doing cosmetic things. We can get in, get out real fast. Number three, it saves us on time and holding costs. And the quicker that we can get in, get out, get our profit on a flip, the better it is for us.
These are probably $7,000, $12,000, $15,000 flips in these scenarios.
Yeah. But if we had to go in, pull permits for every single little thing, we planned on knocking down all these walls, bring it all the way down to the studs, redo all the electrical, redo all the plumbing. It better be a sweet deal where we're making a ton of money. Otherwise, we really don't want to go through that entire process. I'd rather just wholesale it to you guys, make 30 grand, and y'all go through that process. And then we'll move on to the next deal, right? And same thing for deals that we're holding on to. Our favorite rentals and properties that we bought, we don't go in and do an entire rehab day one. We want to buy it, do as little as possible, get that thing rented out, and start making cash flow immediately. That makes sense?
I feel like for the example on the Corpus deal, the 8 vacant units, we would do the very minimum, but to still have a property that we're proud of and we're not getting maintenance calls immediately, but basic, quick, clean, get it rented.
Yeah, I mean, if the Corpus deal, for example, was 100% vacant, every unit needed to be remodeled, there was issues with the city or whatever, it'd be a lot less attractive to us because it limits the cash flow that we're going to get. It maximizes the work we're going to have to do to it, and it just opens up the door to a ton of other problems. So we'd have to be getting, just an absolute steal on that deal in order to take on a full-on remodel like that.
And the obvious thing is it would limit us from a lot of other things. And that is not what we want to do, right? We want to maximize my value, Alex's value, our team's value, so we can keep going and keep growing.
Yep.
We don't want to get married to any deal, really.
We've never bought properties cash. Just like we talked about yesterday, real estate without leverage is an average investment. Real estate with leverage is a great investment. So the types of financing that we're able to get on a deal, if it's going to be good financing or not, bad financing can ruin the entire deal. If this Corpus deal that we were looking at, the only loan we could get on it was 11% loan, it would ruin the entire deal, right? So the financing is extremely important. The bank is your lender. You need to have good relationships with the banks, and you need to be able to negotiate and structure the best financing that you can for your deals.
Yeah, I mean, there's a lot to it, right? There's so many different types of financing, so many different sources of capital. Hard money, private money, community banks. If you guys don't have a relationship with a community bank, I highly recommend it. Personally, I'm with Wells Fargo. They're all over the world. That's great, but that's where I keep the least amount of my capital. We have a relationship with Guarantee Bank and Trust in Austin. We know the banker. We have a couple different ones, Frontier Bank. But go and open an account and find somebody that you like, right? And just start that relationship now, because when you want to go and you got this Corpus deal, those are one of the people that we're going to be talking to. And the fact that they already know us and we already have capital there goes a long way. And ideally, you're finding wherever this deal is, like Corpus, we're probably going to try to find a local Corpus banker for that deal. So I would encourage you guys to open an account with some community bank, as well as if you have Chase or whatever big bank that you're with.
Another aspect of the financing, just like point number 1, never pay market value, right? Or over market value. Well, if a property is worth, and let's say market value is $300,000, I would pay $450,000 for that property. So I would pay 50% more than the market value of it if the financing was good. So if the seller agreed to give us that property with a $0 down payment, and they were willing to loan us, the entire balance of the loan over 1,000 years, and they were willing to have, $1 monthly mortgage payments for the first 100 years or whatever, then that deal turns out to be pretty good, right?
Because we cash flow every single month. And we can make it good for the seller too. Hey, Mr. and Miss Seller, we'll pay you double the value of the property. They'll get that over time, but you work with us up front, and you can make a trade-off there.
And this is where the creativity, being able to think strategically, go into these negotiations, into these conversations, use the entrepreneur method. Everything we talked about yesterday and everything we're going to do live today is really important. And that's why I'm telling you that the factors of a deal analysis, you can't, use one single formula to say this is a good deal or a bad deal. You can't just plug it into the spreadsheet or your calculator and say this is a good deal or a bad deal. Spreadsheets and calculators can't factor in the new development that's going to come in and cause this property to be worth, 3x in 18 months, right? And so you have to utilize all the information and all the variables that come into play to make the decision on if it's worth it or not.
Let's say we're the owners of the property, and Aaron, you buy the property from us, you put $10,000 down, and you're making monthly payments. Other than us collecting those monthly payments, me and Alex, does anybody know what option we would have as the sellers to get out of that deal in some other way?
Raise your hand and Andrew's going to come over to you real quick.
Any thoughts? We're collecting the monthly payment. Are we stuck to just collect that monthly payment right here?
One option would be to take the promissory note and sell the note.
That's what I was looking for. So we can go sell that note sell it to David, and David pays, we're owed 100K. David's going to buy it for 70K. He wants a discount. And Aaron makes the payments to David. We get our lump sum. We structured the deal. You made money. So when you really dive into that, you can get extremely creative. Real quick, I just want to understand on the bank side, raise your hand if you do bank with more than one bank. I'm just curious. Most of y'all do. Great. Y'all get it. Cool.
So what an investor will pay, right? We always feel much better about a deal when we know that everybody in this room is willing to pay more than we have it. It's a very important factor that we take into play is, will somebody buy this for more than we're paying today? And if the answer is yes, and obviously, if they're willing to pay $100 more, it's not that big of a difference. But if they're willing to pay 100 grand more, 200 grand more, 20% more than we have this under contract at, then we know that we have this, below market value.
So think about this. If an investor won't pay more than we will pay, we won't do the deal, ever. But let's take that further. The investor has got to be able to make money. That's the only reason they're going to buy the deal. So that means our deal is even better than the average investor. That's a really important factor, right? We would never do a deal if we don't think somebody would pay more immediately, and it's never going to be end buyers because we're not selling primary residences.
Yeah, it's really important. It solidifies one exit strategy that we know we can always get out of it if we need to and utilize this exit strategy to wholesale it or sell it to an end investor. We don't want to get stuck with a property that nobody else wants in case we get rid of it. Value add potential, right? So how much are we